Hello, I'm Michael Hainsworth. Retirement used to be framed as a finish line. Stop working, start spending, draw down on what you built. But Daryl Diamond has spent decades arguing for something very different. He coined the term paycheck portfolio to describe a strategy built around one simple idea. Retire on the income your investments generate, not by selling the investments themselves. Live off the apples, don't cut down the tree for income. If someone nearing retirement could change just one thing today to improve their peace of mind tomorrow, what should it be?
Exactly what we've been talking about with the major income producing assets that are going to deliver that cash flow in retirement. Get into a scenario where you're positioning yourself to be able to spend income, not capital. It changes the game entirely in terms of worry and concern and enhances the sustainability of the exercise.
In this conversation, veteran manager at Maddock joins Daryl Diamond and me to explore why longevity, rising healthcare costs, and the decline of the defined pension plan have transformed retirement into a multi-decade income challenge, and why shifting from a grow and sell mindset to an income-first discipline may be the difference between confidence and constant anxiety in your golden years. But first, artificial intelligence didn't arrive on Bay Street with a parade. It arrived quietly, in the background, improving decisions long before most investors even knew AI was a thing. Today, artificial intelligence is transforming how financial markets function, how risks are measured, and how capital is allocated. At its core, finance is an information business. Prices, probabilities, patterns, behavior. AI excels at processing vast amounts of data and identifying patterns that humans struggle to see. That gives institutions an edge, not by predicting the future, but by responding to it faster and with more consistency. AI already plays a role in credit scoring, fraud detection, trading execution, and portfolio construction. You've probably had a credit card canceled because of an AI-powered fraud alert. AI helps banks assess risk more accurately. It helps asset managers test scenarios, manage volatility, and reduce behavioral bias. In many cases, it isn't replacing humans, it's supporting them. And that distinction matters. The biggest value of AI in finance isn't speed, it's discipline. Algorithms don't panic, they don't chase headlines, they don't fall in love with the narrative. Used properly, AI can reinforce long-term decision-making by stripping out emotion from the repeatable process. But AI, it's not a silver bullet. Models are only as good as their data. Garbage in, garbage out. And over-reliance on automation introduces its own risks, especially when markets behave in unexpected ways. For investors, the takeaway isn't to fear AI or chase it blindly. It's to understand how it's being used, which firms are deploying it responsibly, and which are simply marketing the idea. AI won't eliminate uncertainty in finance, but like every major tool before it, it will reward those who understand it and expose those who don't. Daryl, I feel like we're confronting a structural shift here where longevity and healthcare costs fundamentally change the assumption that we'll spend less in retirement.
You're spot on. This is something that we maybe were not having the same type of discussion on 10 years ago, but it's certainly come to the forefront. I think when we talk about spending less in retirement than we did when we were in our accumulation or working years, I think there's two parts of that. There's a step down in terms of spending less than you did when you were working. And obviously there's lots of expenses that you don't have when you were going to the office every day. The other side of it, which you were alluding to, has to do with healthcare costs, even long-term care costs. And what makes that really difficult is that they're so tough to measure. There's not a line item on a budgeting page for a pre-retiree where you can factor in, gee, we better make sure we're setting aside $1,500 a month for eventual healthcare costs, because you just don't know when they're going to come, the duration of any affliction that has you seeking additional income or capital, and of course, at what age that's going to occur. These are unknowns, like so many other things in retirement. So it makes it very difficult to plan effectively for it. I think people need to be cognizant. I would say rather than spend less, Your spending will stay at relatively even level. I'm just taking inflation out of the equation as I talk about this. Over retirement, you're going to spend roughly the same amount, more at the start, plateaus, dips a bit, and then comes back up at the end for health-related costs. But you don't know, as I just alluded to, you don't know all the factors that impact how and when that's going to happen. So at the end of the day, you see a shift. Less discretionary spending, more related to care and healthcare and perhaps long-term care. Tough to plan for, but there are ways you can mitigate the impact of that through insurance programs, long-term care coverage, certainly things worth exploring because the money has to come from somewhere, and better that it comes from an insurer where you're managing the risk than your own pocket.
So, Craig, what does the math actually look like when longevity meets rising expenses?
This is the challenge that I think we're all facing right now, is that we're living longer. Our needs in retirement are different than we perhaps had estimated many, many years ago, because we can actually spend more in retirement. We used to think about you'd get into retirement and you'd spend less as time goes on, right? And as I mentioned, oftentimes you'd think you'd run out of money or run out of life, quite frankly, at age 90. But if you're living longer, and you need more cost, you need more care, you need therefore more money. Or I think really the way we want to flip it around is you need more income for longer. And I think that's the key that's really changed this whole planning issue and made it a much different puzzle that we're now trying to solve.
You made a very interesting point. You used the word income here. Historically, retirement was framed as a drawdown phase. So how should investors be thinking of retirement as that income generation phase that, to your point, could last decades?
Well, fortunately, we now have people that have saved more, invested more, and you combine that with things like real estate assets, people are way better off entering retirement than perhaps my grandparents or great-grandparents were. You've also seen, and this is an interesting fact, the gradual decrease in the use of defined benefit plans. And people are now self-funding their retirement. So you put that phenomenon together, you now have more of our population thinking about or needing to think about creating pension-like income for retirement. And their investments are no longer just a supplement to their retirement income, they're actually the primary source of it. So as I mentioned before, you combine that with the fact that people are living longer, needing to pay more for quality healthcare, if you think about it, as your lifetime extends. Now this need for income has now become the most important objective for investors, and I'd say by a long shot.
So, Daryl, psychologically, many investors still view retirement as a stop working, start spending scenario. What mindset shift is needed to happen for retirees to treat their capital as an income engine rather than a shrinking pool?
The mindset that people need to take, and remember, it's a big corner to turn. You've been working for 35 years, putting money away, and now all of a sudden you're starting to draw from the accounts that you built. So there's one of two things that come into play in terms of how you approach these withdrawals. And the mindset, I think, is so beneficial to retirees and pre-retirees thinking about that point where they're going to start drawing, is spend the income generated by the portfolio rather than spend the assets that make up the portfolio. In that way, you're not having the same kind of drawdown effect, which is what causes all the angst and concern for people who are worried about running out of money.
You're playing with the house's money, your money.
Yeah, exactly. And again, psychologically, it's a shift. If you owned an orchard, if that harvest of apples created the income you needed every year, spend the apples. Don't cut down the trees.
So we've reframed retirement, longer lives, flatter spending patterns, healthcare uncertainty, and a critical shift from capital depletion to income generation. Now I want to turn to the mechanics: withdrawal rates, sequencing risk, flexibility that can quietly undermine sustainability. Because even small miscalculations, compounded over time, can erode the very foundation retirees depend on. Craig, withdrawal rates. Sounds like a small technical detail, but you've emphasized that they can make or break a retirement plan. It's frightening to me to think that being off by even a fraction of a percent on a compound basis introduces real risk.
Many investors are really comfortable with the trade-off between capital preservation and capital growth. We often think of that as the decision to toggle between, say, low risk or low return investments and high risk and high return investments. But high return and high risk is often associated with equities. and they clearly have outperformed over the long term. The problem there, or the very key variable, is this long-term idea. It's not a big deal if you've got 10 or more years to wait before you need to spend some of your portfolio. But if you need some of that income every month or every year, that high risk part of equities introduces this challenge that traditional investing isn't necessarily the best for solving that income need. So spending too much when the volatility is going against us, and that's the problem, it's going to erode that capital that you need in the future time to generate that income in the subsequent period.
Flexibility sounds attractive, Daryl. You take more when the markets are strong, take less when they're not. But you've described in the past flexibility as a double-edged sword. Where do investors go wrong?
When you have your own assets, now it's that flexibility is good, don't get me wrong, but to come back to Craig's point, which is very valid, that issue of withdrawal rate and the impact that even an additional withdrawal or accessing some capital in your income generating portfolios, that can have a profound impact going forward, especially over the long term. So what you need to assess is if there comes a situation where I need to access capital, obviously, where's the best place to take it from a tax perspective, but also, very importantly, what does it do in terms of the future sustainability of my cash flow? One of the things we love about the paycheck portfolio strategy, and I certainly did as an advisor, is we would talk about the fact that if we're spending the distributions that are put forward to us on a regular monthly basis, really the people managing the entire process have set the withdrawal rate. It's not an arbitrary decision for the advisor or for the client. Here's the income. Let's see how we can factor in to live within those parameters and help capital preservation, which of course assists us in sustainability of income.
Okay, so this comes back to your suggestion about, you want to harvest the apples, not cut down the tree. And when you find yourself in a financial situation where suddenly you need a load of cash, the last thing you want to do is grab the axe if you can. But talk to me more about the withdrawal rate element. Craig, who should actually determine that rate? Is it the advisor? Is it the investor? The portfolio manager at the end of the day? We need to focus on how governance structure reduces decision-making errors.
I think the investor really needs to determine how much they need or want to spend, but ideally that's going to be informed by the financial plan, which incorporates the potential of their portfolio to meet that need over the lifetime of the investor. It's a partnership between all these things in reality. And that's, I think, where the advisor and us as portfolio managers, we can work together to help inform that choice for the client. I think that's the key. As long as you're going in informed, it changes the whole thing. And then the ideal withdrawal rate, well, that really becomes a function of what the portfolio can generate and the volatility of that capital. You put those two together and you get that target, and it's with the target need of the client, and you can kind of get to that appropriate rate for the investor. If you're really capital preservation conscious, you're going to go and buy maybe a GIC today. Let's just say the rate's like 2.5% for a monthly pay certificate. And that's all you're going to get, 2.5%. Unless, of course, you hold back a little bit of capital to make up for some of that shortfall. But at the other extreme, you could be a growth investor and let's say a high risk investor, and you're going to go buy an equity fund and you're going to hope to get, 10%. But of course, you risk in that environment that markets go down, say, 30% at some point in time of your cycle. Either of those extremes is going to have some big implications on your income potential. But let's just flip this upside down. What if instead you focus on investments that generate income? And that's your main source of return. And you sort of put away or put aside that need for capital preservation or even that need for long-term growth. And you then focus on the highest reasonably sustainable income level. And if you do that, to me, that's going to appear as your logical withdrawal rate. And that's at least, of course, from my portfolio manager's perspective.
Yeah, and Daryl, you're nodding there. As Mr. Paycheck Portfolio, I can imagine that you agree. Because the problem is so many retirees still rely on a grow and sell strategy, assuming that they'll be able to liquidate their assets when they need to. And for many Canadians, that's the house.
Yeah, to be clear, the grow and sell strategy does work and can work. So let's use an example of someone has, it's a couple and they both have a RIF account. Perfect. Spend income, not capital. There may be satellite blocks of capital within certain accounts that you designate to be growth pieces. to help with inflation. But that comes down to a strategy of either deferring capital or deferring income to address future considerations. But for the most part, if you think about a solid foundation of a stable income that's replacing the income you had from work or the income that has been designated within the plan that has been set up for you, even more importantly, then you've got a base, a foundation, almost like a formal pension would provide. But I don't want to equate it to a pension because some of the guarantees of a pension obviously are not within the paycheck portfolio, just as flexibility of the paycheck portfolio isn't within a pension. There's always trade-offs, but to have your core income consistent, proven as sustainable, which has been our experience over 20 years of using this strategy, that's a big foundation. And a lot of people out there, consumers, are not familiar with this kind of approach compared to the traditional grow and sell.
So we've exposed the hidden risks in traditional thinking. The grow and sell strategy can work, but volatility and poor governance can magnify the damage at precisely the wrong moment. So I want to focus on implementation. How do we structure a portfolio with income as the primary objective? What does a sustainable monthly distribution actually look like? And where do alternative assets fit when the goal is predictability, not speculation? Craig, you've built what you describe as a one-ticket solution. Is the goal here simplicity, predictability, or is this about behavioral discipline that we've been talking about over our time together? What's the problem that the payout portfolio specifically tries to solve?
Yeah, the goal is really we've talked a little bit about it, but generate the highest level of sustainable income that we can. And that comes from putting income as the primary portfolio objective. Of course, we're not going to completely throw out the benefit of capital preservation and long-term growth, but if you build it as a single ticket portfolio, in this approach, it gives us that clarity of purpose. And then we use all of our possible investment choices together in order to try to maximize that success of delivering that income. It's kind of like having a personalized pension plan. We're going to bring in all the sophistication you would expect in a large pension plan. We're going to deploy that against all the assets. But in the case of our employees, or I guess in this case, we'd say our investors, they're all retired and they're all generating income.
So then what goes into calculating a sustainable monthly income?
We add up all the reasonably expected income that we're going to generate from all the underlying investments. You can sort of think of this like we collect interest on private loans that we invest in, or dividends on stocks, or coupons from our bonds, or the premiums that we receive from writing options. And we add in a little buffer for market, evolution or volatility, and voila, we kind of know what the sustainable income level is. Now, of course, over time, we know that the market will evolve a little bit, and we're going to adjust that in our investments that we make to re-optimize, to maximize that potential for income and capital preservation and growth, so that through time it moves around a little bit. But ideally, add up all the income that we're able to collect, strive for the highest income, and you get the target level.
Daryl, from a client perspective, what changes when retirees move from managing withdrawals themselves to receiving that predictable income stream?
Receiving that predictable income stream is exactly what you want to have happen at the point in time that you retire. As mentioned before, you're replacing a paycheck you used to get from work with a paycheck coming from your own investments, your own assets. So from the point of view, and Craig has underscored it as well, of being able to spend income and not be selling your investments at times where markets are either volatile or negative, what that ultimately creates is a level of comfort and confidence for retirees in both the delivery and sustainability of a regular income. The last thing you want is interruptions and things that blow up. And what I love about the paycheck portfolio strategy and what we found worked so well with clients is that when markets did get volatile and negative, all the clients had to do was stay invested. The income came in over time. The assets regained value and got back to where they were prior to a downturn in the market. And in the interim, the client had regular, steady income. You see this happen over and over again with your clients. And when clients see it as well, it builds tremendous degree of confidence and comfort in the practicality and the functional effectiveness of this kind of a strategy.
What about alternative assets, Craig, investing in anything from a sandwich shop to artwork. Where do alternatives fit into a payout portfolio? And would they matter for income stability or diversification?
Well, artwork is probably not great for this portfolio because it has no income. But your sandwich chain idea, that could really fit the bill. The key, of course, comes back to that most important word, income. And I think you're right, alternatives can really add a boost here. I mentioned about income from loans and that really coming from things like private credit, which would be an alternative investment source. Why? Well, I think you can guess it, because it pays high income. I think it's actually the perfect example of an investment that's really designed for income. So let's just pull on your sandwich chain example here a little bit. So we can lend money to that sandwich chain, which happens to be privately owned. And let's just say they're willing to pay us, 9% today, and we strike a deal with them for 3 years. If all goes well, they sell a lot of sandwiches, we get our 9% return. That's great. Of course, if they have any challenges, we run the risk that we've got to make a deal with them to try to recoup the bulk of our assets in return. And this is the key. There's no upside beyond that 9%. If everything goes great, we get our 9, nothing more. We have issues we got to deal with. So for us, we don't want to invest in just one company, one sandwich shop. In fact, we want to invest in as many different companies as possible to maximize the chance that we're going to get that 9% while minimizing the risk that we have on perhaps any one loan that we use in an alternative bucket. So for that, we've got over almost 1,000 loans in our private investments that we put into the payout portfolio. And to me, that's that diversification, but you've also got this sophistication, all linked towards that goal of that higher sustainable income.
Is there a danger that investors assume a payout solution eliminates risk entirely, Daryl? How should retirees think about expectation versus guarantees?
The idea of this being guaranteed is one that we made absolutely clear with prospective clients and existing clients was not the case. It is, as Craig has alluded to, a managed process. What was so substantial in discussing this with people where we wanted to employ this strategy was that we had, for a lack of a better expression, we had the proof. I know history is not a guarantee, but the ability for the investments that we used in structuring these portfolios over 10, 12, 15, almost 20 years, we never had a situation where the client was disappointed. No, it's not guaranteed, but we can show people examples of how sustainable, how predictable, how consistent the delivery of this income is. And that to me is worth a lot. Again, as was alluded to earlier by both of us, there's always trade-offs in any investment decision. And I don't know of one particular strategy, solution, or product that is perfect, but the Paycheck Portfolio program strategy checks a lot of boxes in terms of what people are looking for and managing risk and delivery of income over a consistently long period of time.
If someone nearing retirement could change just one thing today to improve their peace of mind tomorrow, what should it be?
Exactly what we've been talking about with the major income producing assets that are going to deliver that cash flow in retirement. Get into a scenario where you're positioning yourself to be able to spend income, not capital. It changes the game entirely in terms of worry and concern and enhances the sustainability of the exercise.
And Craig, what about you?
Use the right tool for the job. It's really difficult to pound in a nail with a screwdriver. I'd say invest with someone who understands the right tool for generating lasting retirement income. And after a lifetime of hard work, you've earned the right to rest well. A good night's sleep isn't a luxury, it's your reward.
Gentlemen, thank you for your time and your insight today.
Thank you very much, Michael.
Thanks, Michael.
As Daryl and Craig explained, retirement is not a short glide path. It's a decades-long income project. We've learned that spending may not fall the way past models assume. Withdrawal discipline matters more than most of us realize, and that governance, structure, and diversification all play critical roles in protecting sustainability. But the central insight comes back to Daryl's original framing. A paycheck portfolio is not about eliminating risk. It's about organizing capital so regular income does the heavy lifting. Spend the income, preserve the engine, eat the apples, leave the tree, as he points out. Because in retirement, peace of mind is not built on market timing, it's built on cash flow that you can count on. And with that, you'll be in the money. I'm Michael Hainsworth. Thanks for joining us. Be sure to hit the like and subscribe, all that influencer stuff. It really does help spread the word.